Hi guys, and welcome back to the channel. In today's video, we are going to talk about ETFs. Here, it's full of information and the interest is always growing. This video is a guide. You will understand exactly what an ETF is, how it works, and what the most important features are to know when selecting these instruments. When we talk about investments, we have different goals. It is extremely important not to leave too much liquidity in bank current accounts to avoid having to pay increasing costs or a loss of value of one's capital due to inflation. There's nothing hard in investing money because finance is not complicated if you get the right information and eliminate the thought of losing all your money from your mind. It depends on your level of risk and what types of financial instruments you approach. ETF are funds that trade on exchanges, generally tracking a specific index. When you buy an ETF, it's like buying a basket of stocks. It is already a diversified tool, and you are not buying single shares or single bonds, but instruments that contain hundreds or thousands of these asset classes. You invest in more shares that create goods and services, which therefore gain value over time because we are the ones who consume these goods and services. So in your portfolio, you must have 90 to 95% stocks and bonds. Buying individual stocks or bonds is not complicated, but it is risky and requires more knowledge. I'm making it really simple, but I hope you get to the point. So a wise person would want to eliminate this risk by diversifying their portfolio. This is where ETF come into play. Now you will think that's great, but I don't know how to value an ETF. I don't know how to manage the capital invested over the next 5 to 10 years. And this is where active mutual funds were born, in which there is more than one professional portfolio manager who chooses to diversify and choose the best instruments on the market for you. The manager clearly says, "Don't worry, I'll protect you when the market goes down." Well, however, they are not free. In fact, many reports confirm that active management in general has very high costs. Another note. The market is full of these managers, but there are very few who are able to beat the market or whose strategies are capable of outperforming the reference market. Statistically speaking, we observe that in the medium to long term, more than 90% of active investments fail to beat the reference market. So remove some reserves. If you want to have more aggressive ETFs, then you go for the equity ones and vice versa for the bond ones to keep in the portfolio. You have a ton of ETFs that you can select and customize your investments with. Now pay attention because we are going to talk about the characteristics that you must consider when buying ETF. The first feature to consider is the size of the ETF, which you should not confuse with liquidity. In short, if an ETF is super liquid, the liquidity rather than the size depends on the underlying instruments. In general, a size of more than $300 to $500 million is more than good. You can also consider ETFs with $40 to $50 million, but they are more niche ETFs that replicate a specific type of market. You can always buy and sell ETF in your portfolio. It's not a choice for life. Obviously, if the size exceeds $1 billion, there is little difference between an ETF with a size of $2 billion in comparison. Now it's time to observe which index the ETF replicates because we are talking about passive management. This step is essential because few talk about it. The replica can be physical or synthetic. Physically replicated ETFs are convenient, especially if the index being tracked is made up of many stocks. In detail, there are full replication ETFs and sampling ETFs. For the former, the ETF faithfully replicates the index to which it refers. This means that your portfolio will be made up of all the stocks that make it up. The index is replicated on a one-to-one basis. The physical replication sampling ETF is one in which the most significant stocks that make up the index are purchased using statistical and, as the name implies, sampling techniques. This method involves buying a sample of stocks that are selected in order to create a portfolio similar to the benchmark. The selection of the sample is made according to criteria that allow the ETF performance to adhere to the benchmark. On the other hand, unlike physically replicated ETF, synthetic replicated products do not invest directly in the securities that make up the index. Instead, they invest in a portfolio of securities, whose performance they exchange with a counterparty through a swap contract. Although the mechanism appears complex, it is actually a financial flow exchange with none of the risks that investors believe. Now, you don't have to discard synthetic ETFs right away, but other things being equal, if I have two ETF, I'll probably choose the physical F replica. Another feature to consider is income. With an ETF, we have coupon flows in the case of bond ETF or dividends for stock ETF. We have the option to choose that our ETF also distributes the proceeds to us. Now it depends on the goals of each investor. Typically, you will go to accumulation and then reinvest your payments into the purchase of additional ETF shares is the best choice, and for many accounts can set the process automatically. This cycle where you constantly reinvest your dividends into more ETF makes you earn even more dividends. And that's where the compound interest creates the magic and creates the exponential growth of your wealth. And if you are more inclined to have some extra money, you can go into distribution. Here, however, you have to be careful because there are taxes that you have to pay in the case of coupon distribution. You can, in this case, sell the shares of this ETF. Practically, the coupons of the proceeds are like a sale of the ETF. So, consider tax efficiency. Another important feature is the cost of ETF. We are talking about really low costs because we are operating from a passive management perspective. Here, you have to be careful and not to over-optimize. An interesting example of cost difference can be found in exchange hedging. Remember that in ETF, we often have three currencies: the underlying currency, the ETF currency, and the quote currency. For example, if you are a European investor and you have euros and you want to buy an ETF that replicates the S&P 500 that has a currency in dollars, you can buy the same but hedged ETF that has a slightly higher cost, allowing you to be neutral on the exchange rate change. Another aspect is the price of the ETF. If it is quoted at 50 or 200, it doesn't mean it's better or worse. Pay attention if you want to invest automatically every month. Let's put $150 and your ETF costs $190. See the price aspect here. Another element is to evaluate whether the ETF is listed or not, because you have to consider that your broker allows the purchase of that ETF, which is perhaps listed on specific stock exchanges. Now let's get more practical. To buy ETF, you need an account with an online broker or trading platform. To buy a particular ETF, you need to know its name or ticker, as well as how many units you want to buy. There are brokers like Fidelity, Vanguard, and Schwab. It would take a really long time to explain the individual accounts in detail, because it also depends on which country you invest in, the minimum deposit requirements, tax deductions, and withdrawal fees. To begin, individual traditional brokerage accounts provide access at all you need. With ETFs, you will need to consider performance. You should consider returns at 7 to 10 years at least. If you observe that on average an ETF has achieved returns of 11%, 13%, you can estimate the average that can be achieved in the next 7 to 10 years. The data are indicative. Remember it. Whether or not it continues over the next few decades, literally nobody knows, but we simply use the information we have to make the most educated decisions possible. Then you need to analyze the weight of the largest holdings within the ETF and sector. The distribution of funds among individual companies is very important, because this is where the correlation and overlapping of funds come into play. That is, speaking of an ETF portfolio, you want to diversify or buy various ETF that can differ geographically or by industrial sector. If you find two ETF with the same weight of 30 to 35% in the same sector, for example technology, you will have two ETF in your portfolio with shares of the same companies or sectors. This is bad for returns and it reduces the benefits of diversification within your portfolio. So avoid overlapping if you want a diversified portfolio that has balanced growth and minimal volatility. We also need to talk about positive and negative correlation. Example, two cars moving parallel in the same direction. This is called positive correlation. If they go in opposite directions, it is a negative correlation. Now associate it with two stocks. For example, Google and Microsoft, they are positively correlated because they operate in the same sector. You have to avoid perfect positive correlation as well as perfect negative correlation. For example, if you have 50% of your portfolio invested in REITs and 50% in Google shares, if tech goes well but real estate goes badly, gains and losses offset each other. If you want to limit volatility and balance your portfolio as much as possible, find ETFs that have low correlation. Obviously, these examples are extremely simple. Now, the capital to invest depends on your availability, needs, and objectives. And many brokers offer fractional buying, which means if an ETF costs $100, you can technically buy a fraction of that ETF based on the amount of capital you have to invest. While you've reached the end of the video, if you are interested in learning more about similar topics, here you will find other really interesting videos from the channel. Thanks for watching this video. Click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.